Cindy Strong. I have created a video to help you guys learn more about retirement plans. Hope this helps you in your Series 65 studying. And without further ado, this is the section on retirement plans. Here we go. Okay, first of all, we have Employee Retirement Income Securities Act. And this is to protect the employees from employers mismanaging these plans. This is for private plans only, not government plans or state employee plans. So some of the examples are profit sharing plans, defined contribution plans, defined benefit plans, tax deferred annuity plans like 403Bs, and payroll deduction savings plans. So there are two main people that are involved in the creation and maintenance of these. So first of all, there is the settlor. And this is the person that establishes the plan. They choose the type of plan. They amend the plan. They choose the plan options. They decide on the matching contributions. They decide when to terminate the plan. So this is kind of, think of this as the structure, the backbones. They create it, but they don't manage it. And that's the big difference. They create it, they decide what goes into it, the plan options, but they don't manage it. They don't actually choose the investments, okay? That's the responsibility of the fiduciary, which is the plan trustee. This person manages it in the best interest of all, and the trustee can appoint an investment manager, and then the trustee and the manager have that fiduciary responsibility together. And again, they choose the actual investments. They manage it, whereas the settlor creates it, decides on the structure, decides when it will end. Okay? Hope that helps you, because I was very confused at the differentiation between the roles. Vesting. So when someone is vested, it means that essentially the money is theirs. So fully vested means that the benefits that the employer contributes are then owned by the employee, even when they leave. This usually takes place over 3 to 6 years. Let's think about what that means. So let's say you become employed with a company and they have a 401k option, and they give you the right to start becoming vested, and so they'll say, listen, we'll match you up to 5%. You want to put 5% of your paycheck in here? Then we'll match up to 5%. We are going to contribute. However, if you leave us in 6 months, you're not going to take that 5% we've been putting in. That money will be fully vested. It will be yours. It will be owned by you after you've been employed with us for at least 3 years. So that's logical. It makes sense. Now, the employee contributions, on the other hand, the part that the employee is contributing, is obviously 100% vested immediately. And I say obviously because it's their money. They're just choosing to put it in their retirement plan. So it would be illegal for the employer to be like, I know it was your money that, you earned through work, but because you put it in here, we're keeping it. No, that wouldn't make sense. But the employer can say, this money is not going to be yours that we've contributed until you've been employed with us for a certain number of years. Now, the one thing that a company can choose is to put off allowing an employee to contribute for a certain period of time, like a year or so. Okay, party in interest. The party in interest is anyone involved in the plan. And there are some rules so that we can keep things from getting murky. There are some prohibited actions between the plan and any of the parties in interest. And these are going to be obvious. These make sense. The sale, the exchange, or the lease of property. Loan or extension of credit. Provision of services, goods, or facilities. The use of plan assets. The plan investing in employer-owned real property. The plan investing in the securities of the employer. We don't want to muddy the waters, right? So it makes sense that there are some prohibited actions to keep that separate. And then I just want to give you the definition here of a broker-dealer. They are compensated for the advice and the management of the plan. Okay. Investment policy statement. This is going to lay out the investment policy and the objectives of the policy. It will specify the asset allocations to each of the investment classes. It will outline the investment performance and measurement objectives. It will also establish the risk limitations. The manager and the trustee must both abide by what is outlined in here. And we just talked about them having the fiduciary responsibility. Okay, there are different types of plans, and I'm going to try to help you remember the difference between them. There is a defined contribution pension plan. Defined contribution. The contributions are predetermined. They've already been defined. Sometimes it's the percentage of earnings. Sometimes it's the percentage of the company profits. And here we go with some logic. The longer an employee stays, the higher that benefit will be. That's an incentive to keep working for a company. So the contributions are predetermined. They have been defined. The longer they stay, look, the more money they'll make, the higher the benefit. Then there is a defined benefit pension plan. So what has been determined? The final benefit, the final amount the person will get. Now, there is a minimum funding requirement that must be met every year. They must eventually meet the requirement of fully funding that benefit, but they have some time. The final distribution or the benefit is predetermined, as we said, and an actuary is used to determine the amount. So older employees are going to have a greater benefit than the younger employees. And that makes sense because they're closer to retirement age. And this looks just like one of my kids. It's crazy. Pension Benefit Guaranty Corporation. Okay, this is an institution that basically is there to protect. It covers unfunded pension liabilities that occur when businesses close or can't pay their defined benefit plans. A cap is placed on this. Defined contribution plans are not covered. So the defined benefit, so something happens to the business, look at that. The business is not doing well financially, but this person is supposed to get a defined benefit when they retire. I mean, their whole future existence is reliant on this predetermined benefit they knew they'd get when they were old enough to be sitting in a rocking chair on their porch. So the Pension Benefit Guarantee Corporation, remember, it's the defined benefit plan. So the Pension Benefit Guarantee Corporation says, we have you covered, but there is a cap on that. Okay, there is something called a Qualified Domestic Relations Order. This is a judicial order that splits a retirement plan between two people upon divorce. It only applies to those ERISA plans, okay? So just the private plans, not the public plans. And it essentially says, in the case of a divorce, we will take that retirement plan and we are going to divide it based on the number of years you were married. So we have our judge, we have our divorce paperwork, and then we have the person that has the retirement plan giving money to the ex-spouse. Tax qualified retirement plans. These are deductible against taxable income. Tax qualified means they are deductible against taxable income. This is a little bit different when we're talking about qualified being putting your taxes off and being tax deferred. So here we're talking about the fact that these are deductible against taxable income. The earnings build up tax deferred, okay? And all of the ERISA, employment, retirement, income plans are qualified. Get that? All ERISA plans are qualified. Non-tax qualified retirement plans. The contributions were already taxed. The earnings are then going to build up tax deferred. Just the buildup is taxable. The original contribution that you put in, it's not taxable because you were already taxed on that money. We're going to look at this when we are talking about plans that you can use to put money aside to pay for colleges. We're going to look at this because there are a lot of people who contribute from their paycheck into accounts for their children to help pay for college in the future, like 529s. Those are going to be in this section here, the non-tax qualified, okay? So they've already paid taxes. The earnings are then going to build up tax deferred, and the original contribution obviously is not going to be taxable because it already was. Okay, here we go. IRAs. Everyone has heard of an IRA. Most people don't know what in the world it is. I'm going to tell you what they are. First of all, there are two main types. One is qualified and the other is non-qualified. We just talked about those concepts. Now let's look at them in terms of IRAs. An individual retirement account. There are rules, as there is for everything else. First of all, any employed person can have an IRA. Any employed person can have a traditional IRA. Currently, the limit of the amount that you can fund it with is $7,000 a year. A married couple filing jointly, not separately, but jointly, can contribute double that, $14,000 a year. But they both don't have to be working. So if one's a stay-at-home dad and the other is a working mom, then yes, they have the ability to put in up to $14,000 a year. There is an IRA catch-up for people over 50. They can contribute an extra whopping $1,000 a year. So they could contribute as an individual up to $8,000 a year. The idea is if you're over 50, you're getting closer to retirement. We're going to let you catch up by throwing in an extra $1,000. Okay, this amount that you're allowed to put in does not include any of the income from the investments. It's just the amount that you actually put in. Any contributions in excess are taxed at 6%. So you've got to be aware and make sure you're not putting in more than that. These are front-loaded tax benefits because this is money you've never paid taxes on. You're going to worry about the taxes later. In contrast, we have Roth IRAs. Roth IRAs, the same amount, that's $7,000 or $14,000, can be contributed to these accounts. If the monies are left in a Roth IRA for at least 5 years and you're at least 59 and a half, then you don't have to pay taxes on the withdrawals. These are backloaded tax benefits. This is money that you've already paid taxes on. Therefore, they're not going to tax you again on it as long as you've left the money in there for 5 years and you're at least 59 and a half. Again, the total amount for contribution is $7,000. The total amount is $7,000 between the two IRAs, okay? Now, guess who can't have Roth IRAs? High-earning individuals. High-earning individuals cannot contribute to Roth IRAs. Okay, let's look at what you're allowed to have as investments in IRAs. You can have CDs, stocks, bonds, unit trusts, mutual funds, government securities, annuities, and gold and silver coins. You cannot put into an IRA an insurance policy's cash values, term insurance, art, or collectibles. Here's some more information on individual retirement accounts. If you withdraw these funds before you're 59 and a half, you will pay a 10% penalty. However, there are some exclusions, and those include death or disability, first-time home buyers, and also there are some higher education exceptions in which you're allowed to pull the money out. They're encouraging you to better yourself. They're encouraging you to buy a home. And then obviously if a person dies or they become disabled, then those penalties are waived. The distributions are taxable. Annual payments must be taken by 73. Why? Well, in traditional IRAs, and that's just for traditional IRAs. In traditional IRAs, you've never paid taxes on this money. And so at 73, and this age is changing, but we're just going to use 73 for this example, and I think that's what the Series 65 is still testing on. At 73, the IRS goes, wait a second, buddy. You have never paid taxes on this money. You're not going to live forever. We are mandating, we are requiring that you start taking a minimum distribution out of this account and paying taxes on it. Now, Roth IRAs do not mandate withdrawals at any age. Contributions to both can still be made after age 73. You just have to be aware that the RMDs are going to come out. You are allowed to roll these over into another IRA, and when you do, you keep the same tax-deferred option. You have 60 days to do this. The transfers must be held from one trustee to another. Now, in the case that you harvest a tax loss, you must close all of your IRA accounts. You have to liquidate your assets, and if the proceeds are less than the basis in the account, you can claim a tax loss. Now, distributions can be made over 5 years if money remains after your death, or over the life left of the beneficiary, and they can choose that. So that's pretty cool because there will be a tax consequence. Other retirement plans, okay? We have money purchase plans. This is a percentage of your salary. The plan contributions cannot exceed a certain amount. Usually that certain amount is 25% as the max. It's a plan that's created by the employer, and it requires mandatory employer contributions. So that's pretty cool. Not employee, employer contributions. Profit sharing plans. The company shares the profits with the employees. This is a type of defined contribution plan. The employer decides how much they will contribute. And then there are, as we talked about, deferred compensation plans. Portions of income are deferred until retirement or death. These are non-qualified tax deferred, and there's no ERISA regulation on these deferred compensation plans. There is something called a payroll deduction savings plan, 401k plan that employers match. It's a defined contribution plan. There's a maximum annual allowance. These are also tax deferred. 100% of this is taxable when taken. Again, you've deferred your taxes, so eventually, yes, you do have to pay them. These are subject to ERISA guidelines. Sometimes somebody needs a loan, and if they have a 401k retirement account, they can take a loan for any reason. However, there are some stipulations. The maximum is up to $50,000, so it's capped at $50,000, but it's $10,000 is the max, or half of the balance, whichever is greater. Okay, and it's capped at $50,000. Interest rate is going to be the interest rate of that loan, because you're taking a loan, is going to be based on the current rates. You have to repay it within 5 years. There is also a 10% tax penalty if you are under age 59 and a half, or you meet one of those other guidelines we talked about earlier, and it has to be paid back quarterly. Now, there's something called a top-heavy 401k. This is offered to key people in the company that make more money. It gives excessive benefits. It is not tax deductible, so it's still non-qualified. But it is an option that that employers can offer to certain employees, top-heavy. Here are a couple other options. There's something called a match paid to student loan lender. Companies can decide to make their contributions directly to student lenders. If you have student loans, they might say, hey, come work with us and we'll help you pay your student loans off. We're going to make contributions to pay off your student loans. There's something called Safe Harbor 401k. The employer must contribute to the plan, even if the employee doesn't. And there's an immediate 100% vesting. So that's pretty cool. Safe Harbor 401k. It doesn't mean they have to offer it day one, but once they do, then there's immediate 100% vesting. And then there's the ERISA rule, which is self-directed like a 401k. It must, and this is cool. This is to safeguard anyone from risk. The self-directed, it's self-directed like a 401k, but they must offer at least 3 investment alternatives. And this relieves fiduciary of responsibility for the participant choice. They'll say, listen, we have a really low risk option, a medium risk option, and a riskier option. You choose. Tax deferred annuities, also known as 403Bs, these are offered by school systems, hospitals, foundations. The contributions are tax deductible, earnings are tax deferred, and you can contribute up to 25% of your income a year or $23,000 a year limit. Okay? And then we have 457 plans. These are specifically for government employees. It's a type of deferred compensation plan for management and highly compensated people. The withdrawals can, and this is the one exception, can be made prior to 59 and a half without a 10% penalty. In other ways, they're almost exactly like 401ks and 403bs, and they are sort of by definition top heavy because these are for the highly compensated employees. Okay, and it's for specifically government employees. Education savings plans. So contributions to these plans are not tax deductible. However, the earnings are tax deferred, and this is common, right? We see most of these have the same stipulations regarding tax. The distributions are not taxable. Why? Because this is with after-tax money. After-tax money, okay? But the contributions are not tax deductible, so the people who put their money in these have to claim that they put their money into these accounts. One of them is an education savings account. This one is a tax-free savings plan. The earnings do build up tax-free. You can only put up to $2,000 a year. This is just for middle earning people. Again, contributions are not tax deductible. You have to use this by the age of 30, or there's a 10% penalty to the beneficiary. And I know I've said it, but I want to keep saying it, not tax deductible. Okay? But it is tax-free, meaning the earnings build tax-free. 529 plans. These are mutual funds in a special wrapper, basically. They can be used for a few different things. Higher education is one. There are no maximum contributions. That's cool. They're not federally tax deductible. $18,000 gift tax exclusion applies, so that's cool. They up to $10,000 a year can be used to pay off educational debt. And again, they can be used for higher education, college, or approved foreign programs, like some overseas programs, as long as they're approved. And these are state-issued plans. A couple other education savings plans. One of them, actually, this is the last one, is the custodial account. Okay. This one is opened for the benefit of a minor. Any adult can open this for a minor. It can only be used for the benefit of that minor. There is no limit. They are taxed annually. They are not tax deductible, common. This is cool. The tax bracket of the minor is used. It's owned by the minor, but it's controlled by the custodian. The transfer age is set. The max age for these is 25. And then there are two different types. Both of them have M in there for minor. Remember, the minor is the owner in these, but each of these have different allowances for gifts. And these are irrevocable. Irrevocable. Once you put your money into that custodial account, it's locked. It is irrevocable. And then we're switching pages. There's something called a health savings account, HSA. This is a way to put money aside to build up tax deferred, and then the distributions used for medical expenses are not taxable. Now we're going to totally shift gears and talk about Social Security benefits. In order to qualify for Social Security benefits, you must have worked for a total, not consecutive, but a total of 40 calendar working quarters, which if you do a little bit of division is 10 years. Social Security benefits are taxable, but the percentage is spelled wrong here to make sure you're paying attention. I'm just kidding. There should be an A there. The percentage is excluded from taxes based on your income bracket. That totally makes sense. It's taxable, but the percentage is excluded from taxes based on your income. You must be at least 62 to start claiming Social Security benefits. The full claim starts at 67. You can wait until you're 70. That is the longest you want to wait. That is when the maximum benefit is given. It makes absolutely zero sense to not start collecting your Social Security by 70. All you're doing is taking a chance and not getting money that is owed to you. The spouse can claim up to 50%, and the working spouse still gets the full amount. An ex-spouse can claim up to 50% of the working spouse if they were married for at least 10 years and he or she is at least 62 and not remarried. Let's look at that again. An ex-spouse can claim up to 50% of the working spouse's Social Security if they were married for at least 10 years, that person is at least 62, and they never got remarried. Now, when they're talking about fully versus currently insured, that refers to the amount of time you worked. Okay. And that is the end of this section. I hope this has helped. Leave me a comment, subscribe, let me know what you think.